Greetings, market rebels. Welcome to this week's macro measure video combined with our, let's see if it works, our sector situation video. It is Friday, March 6th, 2026, and probably about just in front of 3:30 here on the East Coast. Here's our trusty market rebellion disclaimer. Here is our trusty intellectual property rights notice. And here is last week's slide with some highlights. Let's get this taken care of quickly if we can. Let me see if it lets me there. Where's my highlighter? Maybe it'll do that. Okay, yeah. Well, there's supposed to be a highlighter up there. I'm not sure what just happened to that, but we're probably going to just go without it. Let me see if my cursor will get the job done. For some reason, it's just not working the way it should. Anyway, last week we went with whistling past or two because we were still really stuck in a range. We don't know fully to this point even where things are in terms of that range. You might say, well, didn't it get broken this week? You could argue that it did, but did it really get broken enough to where you could say this isn't a false breakdown? I don't think you can. So we'll see. We'll talk about that. We'll show that in the charts. Highlights are in that really wild pink color. We mentioned last week serious developments were possible, that we didn't take them lightly or cheerfully. There was energy stored. There's a war looming. What else is looming? Still probably relevant. We thought that we're in uptrends, but we were flirting with disaster in a postural distribution pattern phase. We wondered if the other order effects were, priced in. We leaned towards no, that they weren't. We said that breadth was only off a little, but sector action showed much greater concerns, and we noted that the financial sector risk went from bubbling to foaming over. And then we finished with this that I made as obnoxious as I could because this is one of my things. You get a lot of grief for this type of comment, but this is really how I feel about it. If you're a long-term investor, but maybe a short-term trader, there are things you can do in your trading account or on the trading side to really hedge, right, or reduce your exposure. And I think when things start getting dicey, and they have been getting dicey to an extent, that's when you have to really seriously consider those. So that would be what? It would be if the bull market has many years to run, should you be all in at all times, right? So, or just wait until the clouds pass, as I like to say. And I just feel as though you can do at least a few things there. There's nothing wrong with being bullish long term and being cautious in the short term. I don't know why that is such a problem for people. I see it online. I've heard it over the years. Everybody wants to take a strong stand, but I don't think you really always have to take that strong stand. So, and there's nothing wrong with hedging. Look, if I hedge in a heavy way and my portfolio doesn't lose much and my hedge loses a little bit, and then I'm up and away from there, I'm happy. That's the whole idea. So just because you never know what can happen. Anyway, we went with maintenance of DEFCON shields. That was a no-brainer, and it just kind of remains that way. So let's move on to this week. And this week I'm going with where is I wonder if Microsoft has shifted this to something else because I don't seem to have what I normally have there. Laser pointer. Maybe that'll do it. I don't think I'm going to spend much time on this. There's a lot of things I did put on here for this week. I'm going with neutrality. Caution has been, I think, the right call. We don't do a lot of table pounding. We try not to do a lot of patting of our own backs. But I do really think with so many things lining up, we could rattle just a few off, right? Stretched valuations historically. You've got things like I'm trying to think of the little piece I saw this week where it was kind of like another long-term measure, big picture measure that puts us at some real high levels. We've seen other things that put us at close to 99 levels. In some ways, we had some stories coming out about the circular arrangements that were being made with respect to AI and compute and all these things. We saw some financial problems potentially bubbling up. We saw geopolitical bubbling up. We saw domestic bubbling up. We saw the Fed potentially behind. We saw really not so wonderful things started out looking pretty good in the economic numbers, but not so good overall with what's been revised down in terms of the employment situation or unemployment. And so there's just a lot of stuff out there. And again, people could go with the old wall of worry, but the trends in a lot of those things were getting progressively worse. And I just feel as though if you were somewhat cautious, I don't think you really made a mistake. I don't think there's anything wrong with feeling that that was something you should do. So just want to point that out. We'll do our best. We're sticking with some of these things. I'm not going to go through all of them. We're sticking, of course, just a reminder, we just try to do very objective nuts and bolts charting and discussion. We're just trying to weigh things out, right? If we can come up with a lean, we're going to come up with a lean. When it's been the way that it has been, we haven't really had strong leans. And again, I think that really bore out in our favor because we were willing to be reactive and nimble, more so than committed to one way or the other. And that makes a lot of sense when the market is not trending. And when you have a market that's sort of paused, then you don't always know, right, what's going to happen. You assume it will probably resolve in the direction of the incoming trend. But that hasn't happened yet in a meaningful way. We did not break out the new all-time highs and hold them. There were many false breakouts. And so again, you don't like to go against a trend too early, but you also don't want to believe just because that is the trend that it will persist, especially when the clouds are really forming. And I think they were. The major index ETFs, the weekly charts are not looking good. So is it a real breakdown or is it a false one? And this is a bad start for the monthly charts as well, right? Because this has not been a good week. At the end of the week, you can't call it a good week. This has really been a news and algo-driven mess of volatility. It hasn't, I don't think it's been easy to trade unless you're really in day trading scalping mode because there was just a lot of boring intraday action after they made one move, maybe in the morning, and that was it. Interestingly, there's fewer bears this week in AAII, but the CNN Fear Greed Index is the most fearful it's been in a few months, right? So nothing historic, but it just continues to show that sort of point counterpoint or counterbalance discussion we've been having, right? You can point to, if you want to, you can point to this, that, or whatever if you're really committed to supporting one side or another for whatever reason. But at the same time, I don't know why you would be, given, right, that we, as options traders, we can make money in both directions. And if you're long in your 401k or this, that, or the other thing, you could still find ways to hedge, as I said earlier. So I don't have a problem just flipping around. I mean, I think actually that's the key to being a good trader over the long haul is the willingness to flip around and not be so dead set in your thinking. The historically narrow start of year range is close to expanding. The spies have used the 150 SMA like a champ this week, which will show. And then if that does not hold, then we might be off on our way to the 200 day. And so that's down probably, let's see, another maybe I'm going to call it like 3% ish, maybe 2 to 3%. So we shall see. But we have to start talking about the 500 SMAs and the weekly charts. I think on that note, I'm going to stop the share and we're going to switch over to the charts and I'll come back to this stuff just to start to show about because I don't want to leave too little time and I want this to be reasonable time-wise for everyone. But I'm going to bring up, if I can, I'm going to bring up the first chart that shows up will be just the VIX chart. So let me get my main chart. Oh, it's supposed to be the VIX chart. Where is the VIX chart? Where'd that go to? Oh, it's over here. Okay. All right. So we're going to be broadcasting screen number 3, it looks like. Screen 3 should be coming up now. And yeah, so what I wanted to point out, and the reason I left it on the VIX is I think I've mentioned that I continued to add to my VIX call spreads. and really reduced my long side exposure. Kind of had a few small things. Kind of jumped into a few small things this week, thinking there might be a little bit more of a squeeze here and there, and they just didn't even pan out. Luckily they were very small, but it was me just probably there was slow times and I had an opportunity and I saw some interesting setups, knowing right that the macro situation could do me in. I said, well, I'll just take some small stuff here and see what happens. And then, of course, I got busy and couldn't watch everything as closely as I wanted to, and a lot of those things rolled over. So, fortunately, though, these VIX spreads have been working out well. The reason I brought this up, though, is not because the VIX spreads have been working out well. It's because the VIX, as you can see on this weekly chart, I think it's a little bit easier. We're really at the highest close we've been since last year's March shenanigans, last year's March madness. So take that for what it's worth. But um, this is the first kind of really impressive showing by the VIX in a while, and it's also one of the first times that it really held its ground on a Friday. So that leads to another point in the views of the charts, which I'm going to mention. I'm going to say this, that if there's residual selling on Monday morning, and I don't really go into this kind of stuff that often because I don't feel like it's my place. But this is kind of the first sell-off we've had in a while. Now, you have to remember that earlier this week, let's see, go back to there is Friday, so here's Monday. So earlier this week we closed at 686, which was just a little bit more than 1% away from the all-time highs. So just think about all the hysterics that have been going on and all the arguments by the bulls and bears like online and all this stuff when you haven't even really pulled back all that much from the all-time high in the SPY. So it's just unbelievable what's happened these days, how people really go into a panic in a way when you're not making a new high. And just because they've been accustomed to that. They've been accustomed to being rewarded by buying the dip and in ways maybe that they've never been rewarded before. Now, that's always been the case on the one hand, where that's how the market works. On the other hand, I feel like there's more people that just believe that the government and everyone should step in and make sure that downside doesn't happen. Because I think the government's really enabled that, and well, not necessarily the government is alone, but the Fed, of course, as well, etc. But here's the 150 in SPY on the daily chart, and you can see how right near here, right, that's where they did that super bounce there on turnaround Tuesday, and then this is where they're holding today. So, is there more downside? We don't know. This could very easily be a double bottom. Big positive news comes out over the weekend. They literally gap up, right back up again, and you're off running on a squeeze. I don't think that the market itself is really legitimately uh, on the way to naturally being bought and driven higher at this moment. But you can't rule anything out into squeeze. And I would remind everyone you can start off with a completely sort of normal squeeze or even a slightly bogus to more bogus squeeze and still just keep going and going and going because it forces people to buy. The news cycle turns, things continue to work, get better, etc., or the perception is that they will, then you break out, or people were under positioned and they can really put the screws to them and they're scrambling to buy after liquidating. But what I'm getting at for Monday morning is if they pull off some kind of a really ugly move here on Monday morning where they're gapping this market down, and again, with the VIX doing what it's doing, in the old days when the VIX acted like this on a Friday, there probably was a good sense that there would be more residual selling and panic by people who are thinking, oh no, this is ending ugly, it's getting worse. And it brings the sellers out of the woodwork. I would say if there really isn't major news, right, where things have really deteriorated somewhere, somehow, for whatever reason, geopolitically, domestically, in the financial system, abroad, the financial system, you get the idea. If nothing like that's really happening, it's just a general sort of negative sell-off, and they get near the 200 in purple down here. I think it's probably a great place to at least roll aggressively or potentially cover your short deltas because the first time down, especially through Bollingers, even though these Bollingers, that's a lower Bollinger, even though the Bollingers are relatively narrow, there's a good chance they're going to put a bounce together. Unless, of course, there's more news on the way. Some kind of really negative news, material news that would really kind of override with the natural tendency of the market to find key support on the first go round and bounce from it. So it's tricky, but all I'm saying is in the heat of the moment, if they're opening things down 2 to 3%, I'd like to be a buyer and then see how it behaves. And then if I need to, I'd rather capture the money that I've got and then re-engage if I see fit. If it rolls back over hard, it doesn't look like it can even hold the opening and it's going to be an uglier situation. Now, if it's a material reason where let's say, there's ground forces go into the war zone, and then it's looking like this war is going to persist and expand, and that rattles people like it often does initially. Then maybe you've got to wait it out. But if it's really just overhang from more selling that comes out of the woodwork because people get rattled, and it's not really that big news story, then I'd probably be more of a cover my deltas and then really keep your finger on the left mouse button because you really got to be ready to either left click to potentially trade a bounce if you want, or just re-engage with another short side position. Anyway, that was my first quick comment. The next comment I wanted to share really has to do with the weekly charts. And we don't go to these often because we try to do this in limited time frame because of for a variety of reasons, including my own faults. But really, a lot of people do not want any in-depth discussion, and they just want you to really just size it up, which is for a guy like me is very hard to do because I don't look at things in a certain simple way that works well enough for me that I'm confident that that's all I need to do. So I like to look at a lot of things, which is why I can't really uh, analyze things quickly. It's relatively quick, and you think about how many things I look at, only because I've done it for so long. But it's not as quick as a lot of other people are with the way they like to look at it, which is fine. It's all about what fits you. But what I did is I dropped on some getting below the 20 week. You can see the 50 week is all the way down here in gold. The 20 week is the light blue here in the SPY. And these are the fibs and former like kind of like key levels at 650. So the first fib we would retreat back to is right there at the 23.6, which is near that 650. So just keep that in mind. You really haven't retraced right all that much. And if you were to come down 10% from here, you'd have to trade down to 630-ish, roughly. So let me just mouse over, I think 630. This is a 23.6% retracement, but the 630 number of just to get a 10% pullback right from the all-time high, which is not uncommon, that is going to put you down somewhere near there, right now where my cursor is, which is a little bit further than that. So just keep that in mind because, in some ways we really haven't seen anything yet. In some ways we just haven't seen anything yet. And I'm not saying we will. I just think the possibility certainly is there at this point in time. And I think it's been smart to just be on the caution side or cautionary side and not really force a lot of things. I put a lot of trades in for potential bounces that just didn't happen this week. Here's a weekly view of the Qs. They're holding up better today. There's a couple different fibs on this one. One is of a shorter term move, and one is of one is of the move from really, and the same thing was true for spiders. That's from last fall's low, from where we launched right all the way up. So you can see that on the kind of nearer term, shorter term fib that's of a lower magnitude, we have retraced quite a bit of the move from the top towards these lows over in here, a new low that we made today. So we got down probably about looks like about 47 points. So that's going to put you somewhere in the neighborhood of a what would that be? About a 7 to 8%, I think 7 to 8% drop. To get down to, you only have to go a little bit more to get your 10% drop. But there's a bunch of fibs lining up here for different reasons. The bigger one, probably on the bigger sort of pattern or move, is going to put you at about 581. That would be your first, I think, really big fib. But again, there's a few right near there, 576. Your 50 week comes in at 569. So if you want to know where could you fall to if we fall, that's where I would put it. Now, it doesn't mean we do fall. I just feel like at this stage with everything setting up the way it is, it's possible and that we could get real falls here. And I want to make sure that everyone's got some levels in case we do. Now, you can see other levels here if you believe in this solid charting. You can see other levels too. Just reference it, take snapshots, whatever. Hit pause. But here we are on IWM again with the weekly breaking the 20. Here's your 50. It almost lines up perfectly to the 38.2. So if the 23.6 gives out up here, and you're thinking there's going to be more retracement, it's shaping up that way. You're probably looking at 233.45. So that from 248, that's going to be about 15 points. That's going to be, what would that be? About yeah, that's going to be about 6% from where it would be. 10% down from 271 would be 27 off of there. So that would be 243, 244. That's going to come in about, so you're almost getting there. You're almost getting there. So that's going to be your 10% there. And then that's not surprising. It was looking great. We were so excited. I was hoping we were really going to get that next leg. But I think this war and some of these economic statistics that, again, the government probably dramatically inflated, the fact that the Fed is looking like they're behind with the way things are playing out, all that I think is weighing. When you mix in the financial system issues, you mix the rest of it in. It's a lot of heavy stuff. And so there's the other one. Now I'm reluctant to do this, but since we're here, we'll just do the diamonds on the weekly. And you can see they're breaking the 20. It's a very similar story. And you've got your levels there. You're the 50 weeks, just about right near the 38.2. So if we're going to get more pullback, I would think you drop to 45 and 45.4. And if you drop from 40, that's going to be a 10% pullback roughly to drop somewhere in that range from the all-time high. So there you have it on just the basics there. But I think you could see that those weekly charts are concerning. They haven't done something like this where they've broken in a while. And now you have to determine, right, is that a real break or is this a false break, right? Is this really a shakeout move? And I think the way it would become more of a shakeout move when you look at all four of them, I think really the key one here is SPY holding on right at the 150 because you could get a double bottom and bounce. That could start to lead the other ones back up. It's really held on strongly relative to all of the other three. And if it were to do that, it would probably do it in my book. It's probably going to be on good news, news that's considered good and treated as good by the market. So I would just keep that in mind that there could be at least a tradable double bottom, could be something more than that. It's very tight here. It's kind of like some people will call it like a tweezers, but not quite that tight, right? Where it's just 3 candles. So it's 4 candles, but whatever the case may be, it's akin to that. So yeah, but you have to look at this and say, like we did, I think, are we seeing distribution in here? And you just can't really know until after the fact that you definitely did, but I think we did. I think there was people just saying like, hey, it's been an amazing run in 1 year. And I think what I'd rather do is take some money off the table and look to reposition in some other areas that are maybe not as richly valued, maybe not as overbought, things like that, which again, I don't think that's a crime. A lot of people have a problem even with stuff like that. And I think Oh, I mean the kind of like online warring community, not of course fund managers and people like that, but the online community you see. There's they feel like you're a fool to abandon something because, but you can always again you can if you're pretty good at your timing, you can get in and get out and get back in. When you feel like things are either way overdone or way overdone in the other direction. Here is the diamonds, and this is the 500 day. And you can see that that comes in at about 436, which would be even further down. So that would be more of an overshoot level versus the 450. Well, what did we say? 450.4 or whatever, kind of in that. Sorry, the 45,000 range on the real exchange on the real index. But here on diamonds, that would be about 40, 452 or 450 range. So there's that 500 day. If you're like, oh, what if it really hits the fan? Let's look at the 500 day on IWM. Of course, that's down even further near the 50% retracement. That's going to come in near 223. I'm just kind of making sure you know where all these are. And, you might want to add these to your charts and then just turn them off, right? If we don't really go into cascade selling mode anytime soon, just get rid of them. If this market starts to hold and turn around, and then you could just turn them on, when the market's under pressure. I just keep different screens with them up, but that you can do it however you want. Right below 600, which is just above the 50% retracement, that would be quite a right. That would be quite a pullback, right? That would be like on the order, I think, more of like 15% plus from the highs. And then finally, I think we didn't do the QQQ. I don't think we did that one. And I'll show you where the 500 is on that one. And the 500 on that one is coming in near the 50% retracement on the whole move up from last spring. That's way down there at 519. So that would be really something. It's right near the 50% retracement, and that's the 500 day moving average, all in all those cases that I just noted. So you get an idea where they are. That's just about 524, which is really down there. I mean, I don't know. You just don't know you don't know what kind of a turn things could take. But let's salt away a few items that I had on the PowerPoint slide, and we're just going to do a quick look here. But I'm not going to go into really a lot of depth on this because I think it's just very obvious that, right, energy, we know why that's hanging in there. And if you look at almost everything else, they tried to make the most out of communications, but the leadership sectors, it's kind of gone. There really isn't much leadership at this point. Even materials has rolled over. All these have really rolled over. Even I think I took some profits in XLP. I thought I'd get a little more downdraft today, but I think I might still get it. I'm holding on to some of what I have in there. But yeah, that rolled over. I took my profits on a lot of it. But I was expecting a little more today because the market never looked good to me today. I kind of held on, but the gang's doing a bang up job of lifting that on me into the close off the lows. I guess they think they're going to hide out in there. As I always say, it works for a while and then it just all gives way. So you have to be patient sometimes. But that's sort of, I think that's delusional to think that if we really get routed, somehow the staples are going to be immune. Not to say that they should be sold off for fundamental reasons in that situation. I just mean people just start selling indiscriminately when panic sets in, and they just kind of lamp everything. Anyway, you could just see there's risk off across the board, right? So what I don't really want to belabor that, and we don't do the sector situation work the way we used to anyway. Even something which I think I neglected to cover last week, and I apologize for that, but even something like let's cover XAU, right, where you'll see that even that, right, is going risk off. Now, I think there's a lot of heavy manipulation here for obvious reasons. The CME halting the way it has been, the concern by the usual criminal element that what if all hell breaks loose and a lot of these physical delivery can't really occur. the price differentials of silver and gold in the East versus the West. There's a lot going on here, and there's nothing you can do about it. I'm still long the physical, and I'm going to stay that way. But I did lighten up a lot of my any options stuff. Still have a few things, but that are in minors that I think are going to do better. But I'm not really in SLV or GLD or anything like that right now, or the junior SLIJ, anything like that. But yeah, even like this is now, coming off as well. So they're really getting around to selling so many things, right? So many things. Now, let's take a quick look at the VIX again, just for reference. You can see how that's going out. VIX E, right? This is the shorter term VIX that we mentioned on. This is going out the highest it's been probably in about half a year, not quite. Here is your, just ignore all the rest of these things to try to focus on up here, but here's the left tail risk left tail index I can get. You can see how that's being priced. And we talked about that a lot recently. We talked about skew because they started mattering, and you could see that, puts are really being bid up again relative to calls. Last week it was a little bit elevated. Now it's a little bit more elevated. It could get a lot more elevated in relative terms than it is now before if there really is a real crack up here, before we see it finally play out. But I just wanted to cover those because I mentioned them. And I also want to cover market breadth because market breadth, which was we mentioned this, I think, on the slide this week too, but basically market breadth, we said not too long ago, yeah, we had to ask the question, is it almost like too good to be true because it was doing so well? It was really making new highs, I think, when we reported like 2 weeks ago in the form of the advanced decline cumulative average, just to give you an idea. And we had a lot of really good things happening, cumulative volume. So it was very perplexing where we were thinking this, you really can't nitpick too much about market breadth. But the sectors were really more of a tell, I think. And the economic side, which we talked about, we said, the economic side that is getting lost in this. That is where the concern lies, not so much in the market behavior as a whole. And I just don't know. I mean, the markets seem to have a little bit of a tin ear with respect to market breadth, but the one thing we did notice, and I think we pointed out, is that the McClellan oscillator was sort of rolling over, making lower highs. And you could see now the McClellan's really beaten down to the point where if I mouse over some of these other lows, you're going to see it's near tradable lows. Like these really deep dives by McClellan summation. I'm sorry, McClellan oscillator are really tradable lows, right? And in all these recent cases, I don't want to go back and belabor it. The point I'm getting at is that is another reason why if the gang sells this market with residual selling and there's nothing really materially different, and you get this big sort of 2 to 3% whoosh lower, that's why I'm going to then probably liquidate more of my, if the VIX spikes, which I would expect it to, I'm going to be liquidating some of my VIX spreads, probably a lot more of my VIX spreads. I sold a few and then kind of got into some naked long, cheaper calls. I've got probably 85% of my spreads on and have naked long calls that replaced the 15% that I sold. I just wanted something open-ended just in case there was some over the weekend news that kind of pancake things. So it was more of a swap out than a reduction, let's put it that way. But that kind of takes care of the basics on market breadth. I don't want to belabor that. I do want to mention though that let's take a look at these financials, right? I put this on the slide. These are a little concerning here. If you look at some of these weekly charts, this is JP Morgan on the weekly. That's possibly breaking down below the 50. Now, you'll notice, right, that when they do things like this and it gets really rocked down towards the 100, right, that can be a buying opportunity. So by the time it really reaches that fever pitch, that's why I'm saying keep an eye on the news. If it's material, it's one thing. If it's not and they plunge things, it might be a good short-term buy. at least for a bounce trade in a lot of these things. And then there's Morgan Stanley has yet to breach the 50, but if it does, you can see where the next levels are. But that's certainly right. Losing the 20, failing. This is certainly has that rollover look to it, much like you see here, right? Kind of like you could put almost like a radius on here that you're rolling over. It's the same kind of thing right now. And there's other things that, as I'm sure a lot of you've heard, sort of a rollover here in Goldman below the 20-week moving average, right? So next one down there is the 50, BLK. I say BLK, right? This is what we always talk about when it comes to market problems, and it's the financial sector. And even the mighty BlackRock is on the ropes. And I think you probably saw the news about how they're limiting withdrawals, redemptions, whatever. So this is getting rocked pretty hard. And so there, you can see a lot of the big financials there are struggling. Now, Berkshire, I don't think is BRKB. BRKB. Come on. That is hanging in there, as I'm sure. I think a lot of people have made the case that there's a lot of cash there. So this is probably a company that's positioned better than most to be buying if we do see a real rout, right? That a lot of people are still not expecting. VIX, at this stage, VIX is going out at a level we haven't seen. Let's see. Um, Going out at a level that we haven't seen, yeah, since last year. So you have to go back all the way to there, it looks like, and that is pretty up there, right? You got to get back to this day here where you closed at 33.82. So that was April 21st. So not quite a year, but pretty high stuff. We did see the trend. We've been talking about how the VIX has been trading in this sort of volatile manner, as if they're waiting for something to happen, right? They keep getting in and getting out, and now it finally held on. So again, you get up into the mid 30s, it's kind of next tier up for the VIX. We get that. If I get mid 30s on some ugly opening, don't know if I will, but if I do, I'll probably take half of my spreads off there. And if I see the VIX start retreating, I'll just take the rest of them off. If I see it continue to go, obviously I'll wait on the balance. And then what will happen is I'll I'll if I see any hesitation, right, I'll probably take my money and then look to get back in and reposition. I'll probably move in a little bit longer, I'm sorry, a little bit shorter term and just play the real shorties, much like I did with the metals, where when things got a little overheated in my book, stretch technically is a better way to put it. I was sort of on the side of, well, look, I'd rather not be in a heavily weighted capital intensive stuff at this point. If I'm going to see a give back, I'd rather have it in much less expensive options. And so I moved in from being in the longer term in the outer months. So anyway, I hope that made sense for people that watch the video. I know a lot of people that watch it consistently know what I'm talking about or know what I'm referring to. Anyway, Apple. Here's the first one of the megas. There's Apple, right? Not horrible, right? Holding near the 150. Amazon down there trying to come back. Meta's been sort of flatlining. Microsoft looks like it's ready to try, but right, that always can look that way here and there in a downtrend, and then it gets dicey quickly, in those types of things. So oh, I didn't want to skip over Google, and I did. Google, right? Look at that slide below the 100. Netflix, I think I told everyone we had paper on that. Those guys did, I guess, sniff out. There was a lot of paper. They must have sniffed out that way that deal played out, and they've liked that. It's been at least been a very good reason to squeeze. Tesla, down near the 200, it can be a rough one. Plunging below there, right? That would be scary. That's having a real ugly look complexion wise. So if you're a technical bull long term, you probably don't want to see too much more excursion below this week's low because that just will invite more selling on that one. And especially right at the market's going risk off. And then finally, let's do Netflix. I mean, I'm not Netflix, Nvidia. Excuse me. You can just tell I'm getting tired. And the mighty Nvidia is now also near the 200 there in purple. So this is the perfect point for a lot of these where they could dip these below and do a fake out because the McClellan oscillator's already sort of pre-smoked and then create a rally. It all comes down to the news, right? And if you see sort of abatement after there's been a sort of a generic news sell-off, if it hasn't been backed up by something real, then that's might be your tip. So let's see if I've forgotten anything here, but we got to get into this week, where we talked about that. Yeah, we talked about all these things so far to that point. I would love to just have, oh, there it is, my cursor. But yeah, let's see. Yeah, I wanted to mention this, right, that we're already getting the bounceable levels. That's where we just left off. And so we did mention as good as it gets, I think a couple of weeks ago. We talked about McClellan this week. Again, bounceable levels, we pre-qualified that. So I would get your early crush names, like some of the megas that you maybe want to be in, and other really kind of darling type names that have gotten smoked that you like for comebacks. And I think it's early, but some of the ones that fell first and hard, you may want to get them and some other names that you like ready. Not that you're going to start buying them this week, although you could, who knows? But you probably want to be prepared with that because you could get at least an oversold bounce soon, even if we do get rocked. Now, obviously, right, we always assume the news neutrality. If there's news developments, that can really, as everyone should know, even if you're new, that can really change things. And that's why I'm not someone who is going to be a charting table pounder, especially in the midst of the kind of maelstrom that we're embroiled in right now in this world, in this country. There's so many things, going on. That's why I've got this ridiculous starter line on these slides and have had it now for a while. The psychological energy remains very high. It's very intense right now. I think there's a lot of people, again, reacting very emotionally when we were barely down earlier this week by a little bit more than 1% in the SPY. So I'm still figuring that if we do have some negative fallout, that hasn't fully been priced in yet by this market. That's my take on it, just a gut, more of a gut. And I think the VIX kind of closing things out the way that it has is suggesting that that could have something to do with it, just like it was trading in a volatile manner, sort of telling us to keep a close eye on it because it wasn't acting like the normal uh, dead fish VIX that we've come to know and whatever, love or hate. Anyway, economic numbers, I think they've been rough. I mentioned that. The official USD Purchasing Power Reduction Consortium, aka the Fed, is late. That's my personal opinion. I know that there's been some inflation signs, but I think right now it's been so mismanaged that if they don't start to get rates lower sooner, you're going to have an ugly picture get really ugly, and they'll be behind the curve as they usually are. I'm not so sure though that that's something that they'll really cry any tears over as it's currently comprised. Don't forget about the reverse yen carry. That could start bubbling up. We already have cracks in private credit. There's rumors of more on the way. There's rumors that it's much worse than it's being led on. I think Diamond had company with Lloyd Blankfein coming out this week talking about problems. There were other, let's say, luminaries or notables that have really spoken out on this. Tudor Jones and others were getting in the news, maybe Dalio. This is months back, and they were because the market was wafting higher. They were laughed at by the usual suspects on X that tend to be permables. But as you can see, right, they maybe had a point. We don't know yet. But I think again, they were sort of trying to tell you maybe take a really close look at things, be cautious. which again is really not bad advice, right? Because the market doesn't always go straight up forever, and probably without all the adventures that the Fed and the government has taken over the years, it wouldn't be where it is now without extreme engineering, frankly. Um, so anyway, that's a whole nother subject. There's massive fraud being reported left and right. It's a daily, just every day, there's more and more fraud. So if you want to know why the government, why things are rough, it's because so much money is being wasted on out and out fraud that they collect from all of us. It's making a lot of people very sick, frustrated, angry, and there's obviously a massive loss of confidence in the government, which I can't really blame anyone for, since I'm really an anti-government person from way back. I really am more of a let's minimize it type of person because all they do is end up, well, all we do is end up in a situation like we're in right now. Ultimately, that's what happens virtually every time. We talked about energy. The traffic, of course, in the strait is way down. We talked about all this. We talked about the financial risks. This could spill over worse this spring, which is coming up not too far from now. I think we've got spring forward coming up as well. Um, and so all that could be coming to more of a head if things continue to worsen. As I did put my note in there, so just keep an eye on that for Monday's open. And then again, just the reminders will keep you got to maintain your DEFCON shields, period, right? Even though I'm telling you to maybe start sketching out your lists as well. But again, the market, it pays to be nimble. We've talked about, I think I brought the word nimble back after a while. We used to use nimble week after week after week as a reminder because it's so important, but it could be very important again this week. I mean, just look at the turnaround Tuesday that we had after the gap lower. Then you have this Thursday, Friday that's ugly. I mean, it just showing you, right, that you're not getting that sustained movement in one direction, and being nimble, right, is what would allow you to realize I'm not in a trending market. I haven't been in a trending market. I don't have to force a bullish or bearish opinion. I just have to try to be opportunistic. And when it presents itself, take the trade and don't be crazy about over holding it. Get my rolls in when the momentum starts to wane or there's big news scheduled for the next morning, or you're comfortable or uncomfortable, comfortable just taking the profits, uncomfortable holding overnight due to this geopolitical situation, etc. Just take the money and run. Take the money and run. Take the money and run. Rather than digging in, like a World War I trench and going to trench warfare over people that are perma bulls and perma bears. That would just be my way of approaching the whole trading part of the equation anyway. So as you can tell, I'm running out of gas here. I do hope that something I shared with you this week in this video helps you in this upcoming week or maybe some week in the future. I do want to thank everyone for tuning in. I do want to wish everyone a wonderful weekend, and I hope you're nice and hedged up and ready to be nimble when next week comes. Let's hope that, for the sake of humanity, that things start to cool off and sort of normalize. That would be welcome. So everyone take care, and we'll be in touch next week through webinars, newsletters, etc.